All right, welcome to the deep dive, everyone. We're your shortcut, to getting to the heart of big ideas. You send us the source material, and we kind of break it all down. Today, we are diving into the world of investing with Peter Lynch's classic, One Up on Wall Street.
Ah, yes, a classic.
Now, this deep dive is thanks to one of our awesome listeners who sent in a summary. Really interesting stuff. It's about how you can use your everyday knowledge, the things you're already familiar with, to make some savvy moves in the stock market. Kind of throws that whole need a finance degree thing right out the window, doesn't it?
It really does. And what continues to stand out about Lynch's approach, even after all these years, is that investing doesn't have to be this mysterious game played by, people in fancy suits far away on Wall Street. It's about buying into businesses, real companies that are doing well, not just like trading these abstract ticker symbols.
Yeah. Makes sense.
And that's something we all interact with every day, right? Businesses are all around us.
Absolutely. So let's talk about this amateur investor's edge, this idea that we, the regular folks, might actually have a leg up in the market. How does it even work? What's the secret weapon here?
Well, Lynch is all about using what he calls common knowledge. It's pretty simple, actually. Think about it. You see a new coffee shop open up in your neighborhood, and it's constantly tacked. You don't need some Wall Street analyst to tell you that business is probably doing pretty darn well.
Right.
That firsthand observation, that's valuable information. Those big firms, they might not even catch wind of it until much later when it shows up in their fancy reports. It's about trusting what you see with your own eyes, what you experience firsthand.
So it's like we're seeing this story unfold right there on Main Street before it even makes its way to Wall Street.
Yeah.
We can spot the potential ourselves rather than waiting for the experts to point it out.
Exactly. And it's not just about fixating on that stock price, it's about diving deeper into the company itself, understanding if it's actually healthy and running smoothly. We're talking about its revenue, how much money it's bringing in, its profits, its debt. These are what are called the underlying fundamentals.
Right.
Is the company actually making money? Is it growing? These are the questions Lynch wants us to ask instead of just blindly trusting the experts. And let's be honest, those experts, they don't always get it right.
Definitely been proven wrong a time or two.
Oh, yeah.
And this ties right into his most famous advice. Invest in what you know.
Yeah.
It's not just about, say, seeing that popular coffee shop. It's about maybe understanding the coffee business inside and out. Maybe you worked in a similar business or you're just a huge coffee enthusiast. You really know the ins and outs of that world.
Precisely. And that's where your edge comes in. Whatever gives you a deeper understanding than the average person, that's your advantage. If you're a doctor, you might have a keen eye for medical device companies. If you're a teacher, you're going to notice which educational software is taking off in the classroom. It's about operating within your circle of competence, finding opportunities in areas you're already comfortable and knowledgeable in.
I like that, the circle of competence. Now, the summary we got also mentions looking at whether a company's success hinges on just one product. Why is that so important when you're trying to invest in what you know?
Right, because that raises a big question about whether that success can last. What happens if that one big hit product, that one trick pony, falls out of favor?
Like it was just a fad.
Exactly. Think about all those fad items that were popular for a hot minute and then disappeared. If a company is banking everything on one trendy product, well, their future might be a little shaky. You want to know if they have other products and services, if they're diversified, or if it's all riding on that one thing?
Makes sense. Spread the risk.
Okay, so let's say we found a company in an industry we understand. The next step, according to Lynch, is really getting down to business and doing your own research. But this isn't just a quick Google search, right?
Oh, not even close.
Yeah.
He compares it to buying a house. I mean, you wouldn't just take the realtor's word for it, would you?
I would hope not.
You'd want to check everything, the foundation, the roof, the whole 9 yards. Lynch argues that buying stock, essentially buying a piece of a company, deserves the same level of scrutiny. Why wouldn't you be just as thorough when you're putting your hard-earned money on the line?
Yeah, that's a great way to think about it. So what are some of the big questions Lynch suggests asking ourselves when we start digging into a company? Well, the summary points out a few good places to start. First, why are you even interested in this company in the first place? What caught your eye? Second, what does this company actually need to do to be successful? What are their goals? And then third, what are some things that could get in their way, some potential obstacles? Once you understand those basics, you've got a solid foundation for your investment decisions.
Great. So we've done that initial research. Now let's move on to identifying growth stocks early. The summary mentions 6 categories Lynch uses for this. So let's start with slow growers. What are those all about?
Slow growers are typically those big, well-established companies that have been around forever. They're not going anywhere, but they might not be setting the world on fire either. The summary mentions that they usually grow at a modest pace, maybe 4 to 6% a year.
Okay.
But the good thing is they often pay out dividends, which is basically a share of their profits that goes straight to you as a shareholder. So if you're looking for a steady, reliable investment, these might have a place in your portfolio. Just don't expect them to double in value overnight.
Gotcha. Then there are stalwarts, right? How are those different from the slow and steady slow growers?
Yeah, stalwarts are also those big familiar names. Think of those companies that have been around forever and seem to just keep chugging along. What sets them apart is their ability to handle rough patches in the economy. They might not grow super fast, but they're pretty darn reliable and can provide some much-needed stability when things get rocky. Like, think about companies that sell things people always need no matter what's happening in the world.
Right. Makes sense. Okay, now for the ones that probably get everyone excited. Fast growers. What makes a company fall into that category?
Fast growers are those companies that are really taking off. They're usually smaller, more entrepreneurial, and they're growing at a rapid pace, maybe even 20 or 25% a year.
Wow, that's fast.
Yeah. But here's a really interesting point that the summary makes. Even companies in industries that don't seem all that exciting can be fast growers if they have some innovative edge or dominate their niche. The example they give is Anheuser-Busch. Now, beer might not seem like the fastest growing industry, but if you look at how well Anheuser-Busch has done, it shows that even in a slow growth industry, a company can still be a fast grower.
Interesting. So it's not just about the industry, it's about the company's strategy and how well they execute it. Okay, what about cyclicals? Those sound like they require some extra attention, maybe some experience reading the market.
They do. Cyclicals are those companies whose performance really depends on the overall economy.
Yeah.
When the economy is booming, they do great. But when things slow down, they can take a hit. Their sales and profits are really sensitive to things like consumer spending and interest rates. The key with cyclicals, and the summary emphasizes this, is timing. You've got to know when to get in and when to get out. And it's important not to mix them up with those stalwarts we talked about, the ones that tend to do okay no matter what's happening with the economy.
Gotcha. So with cyclicals, you got to have your finger on the pulse of the market, really understand those economic cycles. All right, now we have turnarounds. These sound like they have the potential to be really exciting or really disastrous.
Yeah, you could say that. Turnarounds are companies that have been struggling. Their stock prices have plummeted, but the hope is that with some restructuring, maybe new leadership, they can bounce back. And if they do, the potential rewards can be huge. The summary mentions that your initial investment could potentially triple, quadruple, or even increase fivefold, maybe even more in some rare cases. But the risk is also huge. They could just keep sinking or even completely go under.
High risk, high reward. Gotta have some guts for that one. And finally, we have asset plays. What's the story with those? Sounds like digging for buried treasure or something.
Well, in a way it is. Asset plays are all about these companies that own something valuable, but the market hasn't quite caught on to it yet. Like, maybe they own a bunch of real estate that's worth way more than their actual business operations.
Oh, I see.
If you can spot those undervalued assets before the market catches on, well, there's potential for some serious gains. It's all about recognizing the hidden value that others are overlooking.
That's fascinating. It sounds like to build a truly solid portfolio, you need a mix of all these different types of companies based on your own risk tolerance and how long you're planning to invest. Now, the summary we got from our listener moves on to understanding a company's fundamentals in more detail. What are some key things to look for there?
Lynch has a great analogy for this. He says it's like looking under the hood of a car. Don't just be impressed by the shiny paint job. You need to understand how the engine works, how everything fits together. One key thing he emphasizes is what he calls the earnings line. That's how a company's profits have been trending over time.
Okay.
And typically, the stock price follows that trend. So if you see a big difference between the stock price and the earnings, that could signal that the stock is either overvalued or undervalued. It's a clue to dig a little deeper.
Makes sense. So instead of trying to predict what earnings will be in the future, which, as the summary advises against, what should we be focusing on?
It's all about understanding how a company plans to grow its earnings. There are a few main ways this can happen. They can cut costs, maybe by streamlining their operations. They can raise prices if they can get away with it, of course. They can expand into new markets, try to sell their products or services to a whole new group of people. They can try to sell more of what they already have to their existing customers. Or they can even sell off parts of the business that aren't making money, kind of trim the fat. It's all about that bottom line. How are they going to make more money?
So it's about understanding their strategy, not just guessing at numbers. The summary also mentions the PE ratio. Can you break that down for us a little? Why is that important?
Sure. The price-to-earnings ratio, or PE ratio, is a quick way to gauge whether a stock is relatively expensive or cheap compared to its earnings. It basically tells you how much you're paying for every dollar of earnings that the company generates.
Okay.
A higher PE ratio could mean that investors are really optimistic about the company's future growth, but it could also mean that the stock is overvalued. A lower PE ratio, on the other hand, could mean that the stock is undervalued or that investors are a little bit skeptical about the company's prospects. But remember, comparing PE ratios is most useful when you're looking at companies within the same industry. Different industries have different norms for what's considered a good PE ratio.
Right. Got to compare apples to apples. That makes sense. Are there any maybe less obvious things about a company that could actually make it a good investment, things that most people might overlook?
Oh, absolutely. And this is where Lynch's approach gets really interesting. He points out that companies in those industries that aren't glamorous or even seem downright boring, those can be great investment. Yeah, because they often fly under the radar. If a company has a name that makes people yawn, they might be a hidden gem. They're not attracting the hype and speculation. And think about those companies that provide essential but maybe kind of icky services, like waste management. Nobody wants to think about garbage, but everyone needs someone to deal with it. Those kinds of companies often have a really steady, reliable demand. Then there are spin-offs. That's when a big, complex company decides to split off a smaller part of its business into a separate, independent entity. Those spin-offs, they can often be great opportunities for investors who are willing to do their homework.
Interesting.
And of course, if a company isn't being followed by a bunch of Wall Street analysts, that might mean there's potential for some undiscovered value there. So it's all about thinking outside the box, looking for those hidden gems that the crowd has overlooked. That's what Lynch is all about.
So contrarian thinking, like zigging when everyone else is zagging. What about positive signs, things that make you think, yeah, this could be a winner?
Well, one thing that the summary highlights is what the company's own management team is doing. If they're buying up shares of their own company's stock, that's a pretty good sign. They're putting their money where their mouth is, right? And if the company itself is buying back its own shares, that can also be a good sign. It can increase the value of the remaining shares and potentially boost the stock price.
Makes sense.
And then, of course, you always want to look at what the company actually sells. Do they offer products or services that people need to buy regularly, no matter what's going on in the economy? Those companies tend to have more predictable revenue streams, which is always a good thing for an investor.
Right, stability. But there are also those red flags, those warning signs that say, maybe I should steer clear of this one. What are some things to watch out for there?
Definitely. One thing that the summary warns about is what Lynch calls diversification. That's when a company tries to expand into totally unrelated businesses that don't really make sense strategically. They're spreading themselves too thin, and it can backfire.
Okay, so stick to what you know.
Exactly. And if a company relies too heavily on just one big customer for most of its sales, that can be a risk. If that customer goes away, the company could be in big trouble. And Lynch is also really cautious about those so-called hot stocks and companies that are being hyped as the next big thing. They often come with sky-high expectations and valuations that are really hard to justify.
Right, so don't get caught up in the hype. All of this points to the importance of thinking long-term, which brings us to the idea of, well, long-term investing, right? Why is that so central to Lynch's approach?
The summary makes it clear that those truly big gains in investing, those often take time to develop. You're not going to get rich quick. It can take years, maybe even a decade, for a company's growth potential to really play out. He contrasts investing in stocks, which is like owning a part of a growing business, with investing in bonds, which is more like lending money and getting interest payments. Stocks, over the long haul, they have the potential to generate those big returns, but it takes patience and the willingness to stick with it, even when the market gets bumpy.
Yeah, you have to be able to ride out those ups and downs. That leads us to the value of patience and discipline in investing. What does that mean in practical terms?
It's about staying the course. Don't panic and sell everything when the market takes a dip, especially if the underlying reasons you invested in a company in the first place are still valid. The summary also talks about building a diversified portfolio, spreading your investments across different types of companies to balance those risks and potential rewards. And Lynch's suggestion is to hold as many stocks as you can comfortably follow and understand. Don't overwhelm yourself.
Right. Focus on what you can manage. One of the hardest things for a lot of investors, I think, is resisting the urge to try to outsmart the market, to predict what's going to happen next. That's where speculation and market timing come in, and the summary is pretty clear that those are things to avoid.
Oh, absolutely. Trying to time at the market to buy low and sell high consistently, that's notoriously difficult, even for professionals. They rarely get it right. The summary points out that this whole idea of selling your winning stocks and hanging on to your losing ones just based on the stock price, that's often a mistake. The current price might not actually reflect what the company is truly worth in the long run.
So how do you know when to sell then? If it's not just about the stock price, what should guide those decisions?
Well, the summary suggests thinking about the type of company you own. Like if you have a stalwart, one of those steady, reliable companies, and its stock price shoots up to an unusually high level, well, that might be a good time to consider taking some profits off the table. But with a fast-growing company, one of those companies that's really taking off, you might want to hold on to it for longer, as long as that strong growth continues. The main thing is to focus on how well the company is actually performing over the long term, not just those short-term stock price fluctuations.
Makes sense. It's also worth keeping in mind, as our listener pointed out in their summary, that One Up on Wall Street was first published back in 1989 and then updated in 2000. So some of the specific examples might be a bit dated, but the main ideas, the principles, those are still just as relevant today as they were back then.
Oh, absolutely. Those core principles of understanding businesses and thinking long term, those are timeless in the world of investing.
Yeah, totally agree. The summary also briefly mentions mutual funds and SIPs as good options for people who want to invest for the long term, but maybe don't have the time or the desire to do all that research on individual stocks. It's a way to kind of put those principles into action without having to be super hands-on.
Absolutely. It's all about finding what works best for you and your situation.
So, to wrap things up, this deep dive into Peter Lynch's investment philosophy has been really enlightening. And we have to give a big shout out to the listener who sent in that fantastic book summary. It's amazing how much valuable information we can glean from those summaries. We've learned about the power of using our own everyday knowledge, the absolute importance of doing your own research, the different kinds of growth stocks, understanding a company's financial health, the need for patience and discipline, and of course, avoiding those pitfalls of speculation and trying to time the market. So much great stuff to take away.
And I think Lynch's core message is really empowering. He's saying that everyday investors, people like you and me, we can be successful in the stock market. It's not just for those Wall Street insiders. Just pay attention to the world around you, do your homework, and you can make smart investment choices.
It's about taking control of your financial future. So for all of you listening out there, we challenge you to take a look around. What businesses and products are part of your everyday life? Could one of them, using what we talked about today, be your next investment? Start looking at the world with those investor eyes.
Absolutely. You might be surprised what you discover.
And as always, if you have any sources you'd like us to explore in a future deep dive, send them our way. We love diving into new topics and learning right alongside you.
Always happy to explore.
Thanks for joining us on The Deep Dive.
Until next time.